Hi, folks. Welcome back to Mukti Finance Academy. Today, the third company which we are going to discuss from the EMS space is PG Electroplast Limited. So, if you haven't watched my previous videos on Sirma, SGS, and Keynes Technologies, please do watch them as well. Those are already live on the channel. Quick disclaimer, I'm not a SEBI registered analyst. The companies which we are going to discuss are purely for educational purpose. So now let us start. So PG Electroplast is not just a manufacturer. It is a high conviction proxy for the India's Make in India theme. The company has successfully navigated the difficult pivot from a low margin plastic molder to an ODM powerhouse. By designing and engineering the products they build, PG Electroplast has moved from the periphery to the core of the consumer durable supply chain. As of 9 months fiscal year 2026, the product business commands 73% of the revenue mix, proving that PGEL's one-stop solution strategy is working. They aren't just stamping parts, they are delivering fully assembled air conditioners and washing machines to over 70 global and Indian brands. This backward integration, which includes molding, sheet metal, PCBs, and tools manufacturing, is their primary mode, allowing them to capture value that pure play EMS competitors often leave on the table. So, with nearly 10,000 plus employees across 11 specialized manufacturing units, with a client reach of nearly 70 plus leading brands, including giants like Voltas, LG, and Havells, and the company is having extensive capacity in Greater Noida, Ahmednagar, Bhiwadi, and Roorkee, and 18 times revenue growth over the last 9 fiscal years shows its long-term velocity. This integrated model is the only reason PG Electroplast can survive the shifting industry dynamics we see. So the Indian consumer durable sector is no longer a luxury play. It is an essential infrastructure play for the Indian middle class. Within the current macroeconomic framework, this sector is a priority pillar for domestic manufacturing. According to IBEF data, Indian consumer durables market is expected to reach 22 billion. So by 2026, government reforms like PLI schemes and Digital India are forcing a shift from import and sell to make in India, with penetration levels for AC still below 10% and washing machines under 15%. The TAM is massive. PGEL is positioning itself to be the factory floor for this demographic explosion. So, what are some key tailwinds for this company? Are policy push like PLI schemes and import restrictions on components, and rapid growth of tier 2, tier 3 cities, and rising disposable incomes. And with a low penetration ratio, India is the fifth largest consumer market with vast headroom. And some headwinds includes input volatility. Raw material costs are currently staggering 82% of sales, and pricing pressure in the RAC segment as more players are entering, which can lead to margin erosion, and constant need for capex, which, since this is a very capital intensive business, so these are some headwinds to be monitored. So while the rising tide lifts all boats, PGEL's ability to generate alpha depends entirely on its segmental execution. So you cannot analyze a diversified EMS player by looking at consolidated numbers alone. You have to look at under the hood. For PGEL, the growth engine is running at two different speeds. AC business, the room AC segment generated nearly 2078 crores for the 9 months fiscal year 2026 period, with a 27% year-on-year growth. The commissioning of the Supa and Bhiwadi units is timely, but the real test is whether these units can hit peak utilization during the upcoming summer season. Second, washing machines. This is the star performer, clocking a 46% growth in 9 months fiscal year 2026. TGL is clearly gaining market share in the outsourcing wallet of major brands. And third, it's new frontiers like refrigerators in Sricity plant. The groundbreaking of the Sricity plant is the next big bet. By entering refrigerators and moving into South India, PGEL is de-risking its geographic and product concentration. Here, growth is impressive, but for financial quality of that growth, specifically the bottom line, requires a forensic examination. This is where the bull story meets the reality of the income statement. Investors must ignore the top line vanity and look at the sanity of the profits. So, the Q3 fiscal year 2026 sales growth of 45.9% year on year looks spectacular on a slide. But the 9 months performance tells a darker story. Despite a 20.7% increase in sales, the 9 months profit before tax declined by 7.9% and 9 months PAT declined by 10.5% year on year. Why? The cost of raw materials ballooned to 81.8% of sales. The company is selling more but keeping less. This is a classic margin pincer where high input costs are eating the top line gains. And the company's net debt to equity ratio also remains low at 0.03. But look at the cash. Net debt shifted from a surplus to a positive debt of 78.9 crores. More importantly, other non-current assets exploded from 312.7 crores to 692.2 crores. This represents a massive drain on liquidity, likely tied up in capital advances for the current capex cycle. So PGL is currently in a profitless growth phase. Sales are soaring due to capacity expansion, but high raw material costs and interest expenses are crushing the bottom line. The growth is real, but it is currently expensive and thirsty for cash. So, in a high capex businesses like PGL, capital employed is the denominator that reveals the truth. When you spend 1200 crores on capex, you must generate enough EBIT to justify it. Currently, PGL is failing that test. The ROCE dropped from 23.5% to 18.6%. This is the result of the denominator effect. Capital employed has exploded to support new plants, which are in Supa and Diwadi, but the numerator EBIT is a stagnant. The cash conversion cycle also stretched from 54 to 69 days, primarily due to a jump in receivable days from 47 to 63 days. So, but there is a slight improvement in fixed asset turns. It shows that new plants are actually being used even if the margins aren't there yet. So management's say to do ratio is high on execution but optimistic on margins. They are sticking to a fiscal year 2026 sales guidance of nearly 5,700 to 5,800 crores. But the PAT guidance of 300 to 310 crores, only 3 to 7% growth, is an admission that the margin recovery will be slow. So management is also over delivering on physical infrastructure but underperforming on bottom line conversion. They are effectively asking investors to wait for operating leverage to kick in during fiscal year 2027. In the EMS sector, you pay a premium for growth, but how much is too much? So if you see its peer competitors like Dixon Technologies remains the gold standard, trading at a significant premium due to its asset-light model and massive scale. Second company, Amber Enterprises, which is a direct competitor in the RAC space. PGL currently sits between the two, trying to capture Dixon's multi-product valuation while facing Amber's cyclical RAC margin pressures. So, with revenue growth flowing to 17 to 19% compared to historical 38% CAGR and PAT growth effectively stalling, the current stock multiple looks full. The market is pricing in a perfect summer for AC sales. So the stock is no longer a bargain. It is fairly priced for its growth, but it leaves very little margin for error if the Sricity plant faces delays or if raw material costs stay elevated. So what are some key red flags in this company are working capital stress. A 15-day jump in the cash conversion cycle is a liquidity warning. Unpaid bills, which are receivables, are standing at around nearly 1100 1100 1163.7 crores as a massive weight. And interest costs also grew from 35.6% for 9 months, far outstripping revenue growth. This is the price of aggressive expansion. And while they serve 70 plus brands, the core of the business remains dependent on the big three in RAC and washing machines, likely are Voltas, LG, and Havells. A shift in their outsourcing strategy would be catastrophic. So the 9 months profit before tax decline of 7.9% is the ultimate red flag. When a company grows sales by 20% but loses 8% of its profit, if it is losing the battle against input costs. So what are some key strengths are integrated ODM capability, fixed asset turns improving to 6.03 times, and weaknesses are working capital stretch and margin erosion. Some opportunities are Sricity refrigerator plant entry into South India, Goodworth JV with 50-50 with China India, targeting 850 crores is a key opportunities. And threats are input cost volatility and intense pricing wars in the room AC segments. So over the next few quarters, we need to watch their margin recovery, whether it will return to 9.5% EBITDA margins or not. And receivable days, can they pull this back below 55 days or not? And Sricity commissioning, any delay here will hurt the fiscal year 2027 thesis. And washing machine growth, whether it can sustain 40% plus momentum is a vital. And Goodworth JV revenues with a target of 850 crores with 57% growth. And PBT rebound, profits must start growing faster than sales to justify the valuation. So this is what I understood from the Q3 fiscal year 2026 results of the PG Electroplast. If you do like this video, please do like, share, comment, and subscribe to Murthy Finance Academy. Thank you.